Hello, and welcome to this corporate courses guide on the 7 tips from the greatest value investor, Warren Buffett. Let's go ahead and get started so you can kind of start understanding what these 7 tips are and how they can help you to better your investment strategy. So the tip number 1 is never invest in a business that you don't understand. This sounds pretty obvious, but we'll notice that Warren Buffett will invest in companies like Coca-Cola and General Motors and businesses that are very simple and basic to understand why they're popular or why people want them. The reason he does this is because in value investing, you'll notice that the stock may have some bad news against it for the reason why the company is trading at a lower value. Well, the reason he does this is because when you have a simple business that you can easily understand, you can understand what's stupid information that's coming out that doesn't really matter in the long term and what actually matters. So it can help him better understand why he should be in a company and why he shouldn't be in a company, and helps keep him focused on the long term. The second is better to buy a wonderful company at a fair price than a fair company at a wonderful price. This goes to the idea that sometimes companies will get beaten down and their price will be super low to the point where you say, oh, well, how much lower can they go? Or maybe it's just oversold. You hear that often, and sometimes people will say, I'm just going to invest in it because the price is getting so low. Well, that may be great for somebody who's looking to trade or looking for quick in and out patterns, but Warren Buffett is somebody who tries to invest in the long term. And sometimes companies like that aren't good long term plays because their company is beaten down so much to the point where it's actually what they're worth, that their product isn't worth anything to the market anymore. And he's looking for companies that are going to be there and produce profit 10 years, 20 years down the line. Number 3, if you won't own a stock for 10 years, don't own it for 10 minutes. This kind of goes back to the idea of thinking far out in the future and where this company could go from here. And basically that if you don't see a good big picture progression for the company, why would you own it for 10 minutes? Because it kind of goes back to the thing that Warren Buffett is an investor for the long term. He's not a day trader. He's not somebody like that. So maybe it will work out for you in that little 10-minute short spurt that you invest in the company and get back out. Maybe you make a little bit of money. But if you're going to follow his investment strategies, then you need to understand that you're looking for big picture or not looking for the short-term 10-minute trades. Number 4, the stock market is designed to transfer money from the active to the patient. Obviously, Warren Buffett is somebody who's looking to invest for 10, 20 years, looking to invest very long term. And he finds that he makes his best returns on companies that have a good big picture and investors who are willing to wait for that long-term picture to play out, and sees that people who are very active have a very low success rate. This is why we see that many mutual funds and many actively managed funds don't beat the S&P 500 over a long period of time because of this active movement around. That's why he stays invested for long periods of time in good companies. Number 5, it's not supposed to be easy. Anyone who finds it easy is just stupid. And so you see this in very like booms and bust cycles where people will just kind of throw their money into the market and all of a sudden they start making money hand over fist and they think it's the easiest thing ever. And basically the meaning of this is that if it seems very, very easy, it's probably not a good idea. And that basically if you just threw your money in without doing any research or anything like that and you're just making money hand over fist, there's probably no strategy to it. There's no way of that you're actually putting in the work to understand what exactly you're investing in. And so basically what this comes to the idea that you need to put in the hard work to research into the company so you can understand whether they have a good big picture value or whether they really don't. And when you put in your homework and you understand what the company does and who they're all about, you can really start to see this rather than just throwing your money in the market. Number 6, price is what you pay, value is what you get. And so this kind of goes back to the thing of buying a company for a fair price, which is a wonderful company, or buying a fair company for a great price. So basically what he's saying here is that you can basically overpay or drastically underpay because sometimes the company is worth that, sometimes the company's not worth that. You need to understand what you're getting for your money and think on very basic terms. And basically you're getting value, but price is what you're going to pay. So you could possibly pay $100 for something that's really only worth $5. And so what his strategy is designed to do and what he tries to do is look for companies where he's getting more value than what he's actually paying, and that's how he makes his money, because over the long run, other people in the market will start to realize this and start to put money in those stocks, and that's how those stocks go up. Number 7, and the last one, and this one I think is kind of interesting, is Wall Street is the only place where people ride in on a Rolls Royce and get advice from those who ride the subway. And basically what this means is that we got to watch who we get advice from and whether it's actually good advice. And many times people will get advice from their brother, cousin, sister's mother-in-law, and somebody who they really don't even know, but just because it sounds like the most awesome idea ever, they start throwing money in it hand over fist, and that's how you lose money because they didn't put in the work and they're just getting quick tips or stock tips from somebody that it seems like a halfway decent idea, and that's their basis for their investment. So you really need to understand what you're investing in and make sure that it's a good investment and that you're not just investing off a stock tip that somebody said just invest in this because of XYZ and it's a halfway decent idea. So thanks for watching, guys. If you like this video, go ahead and give it a thumbs up and subscribe. Let me know down in the comment section what other videos you'd like to see for this channel and what you'd like to learn about or how I can help you the best. Thanks for watching.